Tom Bowley. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this edition. This is February 1st, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. And I'll be with you for the next 30 minutes or so as we prepare for the next trading day to open. Pretty interesting action we saw yesterday, so might as well get started with that. Hold on one second, just trying to get one screen set up here. Yeah, we had the Fed meeting yesterday, and of course, I always worry, as we go into a Fed meeting, as to whether or not, there's going to be something new that's going to come out, or the market takes wording or language just a little bit different than I'm expecting. And so I gear up for just about anything. We were in our trading room yesterday, and I was talking about, the fact that from a trading perspective, I always like to lessen the load in terms of individual stocks going into a meeting, because the history is that there's just a tremendous amount of back and forth, and we really don't know which way it's going to go. And a lot of times you get head fakes, and it usually starts at 2 o'clock with the announcement. And that's certainly, what we saw yesterday. I mean, we had action all over the place. At first we went down, looked like we were going to take an immediate drop. Then we came roaring back, went up almost, I think, close to daily highs, depending on the index you're looking at or the area of the market. And then the final hour, things just kind of collapsed, and we saw the market free falling, really, something we haven't seen maybe in the last few months. And I've talked recently about, we've got a few short-term warning signs. We've got negative divergences and so forth, but we're waiting for some kind of a bigger volume, reversing kind of a candle. Well, I mean, yesterday kind of had that feel to me. Now, I'm not looking for a lot of selling, but I would not be surprised if this is the start of a little bit more consolidation. I believe later today, after the bell, we're going to have a chance, because I do think there are a couple of earnings reports coming out that I think could be strong based on the way these stocks have been trading, namely Meta Platforms and Amazon. I think both of those could produce some pretty good numbers, especially Meta. I think Meta is going to have a really good report. But we get the largest company of all, Apple, that reports, and Apple to me just kind of looks so-so. Wouldn't be shocked to see maybe a little bit more, I don't know, bad news, but just not great news coming from Apple. We'll see how that plays out. But anyway, we had the Fed kind of muddying the waters a little bit. I'm not a big fan of Fed Chief Powell. Last meeting, he was talking about increasing the number of rate cuts, and as a result, kind of came across maybe a little bit more dovish than he had been. The market really liked that. Of course, the rest is history. We've seen a big move to the upside. Yesterday, Powell said some of the same things, but I think the focus was more on the fact that he was talking about, hey, we're not going to be cutting in March. It's going to be later in the year. And I think there were a lot of bulls that were kind of hoping that, hey, this could get started earlier than what the Fed's been talking about. And I don't know what the odds were exactly, but I think they were around 50-50 or maybe even greater, that the first rate cut would come at the March meeting. And Powell, I thought yesterday, effectively squashed that. Said, we're not looking at cutting in March. So I think that was probably maybe the biggest part of what happened yesterday afternoon, because the policy statement itself, we went down, we went back up and so forth. But then later, during the conference call and so forth, when he was talking about everything, that's when we started to see some pretty significant downward action. I was actually in a meeting throughout the afternoon, so I didn't follow it that closely based on what he was saying and when the market was going down. But after looking at it, that's kind of the story it was telling me, that the big disappointment was that he effectively squashed the March rate cut possibility. Doesn't change anything in my mind. I mean, I think he still acknowledged that inflation's coming down. He did point out, hey, we want to make sure it's getting closer to our 2% target, whatever. I mean, he's been saying that for a long time, going to the target. Originally he was going to, stop raising rates or whatever. If we just, we talked about, hey, we just need to start need to slow inflation, and at least start turning lower. And then, things just evolved. And I think that's been kind of his entire term has been kind of this, well, I didn't really mean that. I kind of mean this kind of a thing from court or from meeting to meeting. And personally, I'm not a big fan, but what does that matter, right? I'm just one person. But I do think that the tendency when when the Fed meets and he starts talking, the tendency is for the market to sell off. And I think a lot of that is planned. I believe that, stock market weakness helps to keep the economy, slows the economy, slows consumer spending and so forth. And so I think he's using the market in that way a little bit to help with inflation. I'm not really a fan of that, but again, I'm not going to get into that. But that's one of the problems yesterday was the Fed, no doubt. But hey, it was also driven by a couple companies disappointing. One in particular that I had mentioned to members, and I think I did a chart of the day not that long ago. I believe it was a chart of the day, or maybe it was on the show. I don't recall. But I did a chart showing Meta versus the internet stocks and how it was going straight up and at a 52-week relative high to its peer group. And then you saw Google, Alphabet, going like this on a relative basis versus the internet group. And so you had the tale of two internet companies, Meta, which seems to be, on fire, or at least, Wall Street certainly supporting the company, showing a lot of relative strength. And then you have Google on the opposite end. Even though it's going up, it's not that Meta was leading the internet group. The internet group was leading Google. So Meta was really responsible for a lot of the strength, and other internet companies as well. But Meta was a big player in leading the market to the upside. And then we have Google, which on a relative basis had been going lower. So I said at the time, I think we're going to have a good report by Meta. I'm not so sure about Google. Not really liking the way it's been trading. So I wasn't really surprised by the reaction that we had in the Google report. And I wouldn't be surprised if we see some more weakness in Google for maybe a little bit, at least a few weeks to a month, maybe a couple. I don't know if that one's going to come roaring right back. But tonight, like I said, Meta reports, that's going to be kind of a big deal. The third story, and then we're going to get to the charts. Third thing that happened yesterday, I think really spooked the market, was New York Community Bank Corp. Came in with a big loss. They cut their dividend, try to save capital. Stock, I don't know what it finished down, but I want to say it was like 35, 37, 38%, something like that. So a big drop in another one of these smaller, small to regional kind of mid-sized banks. And the market didn't take that very well. I don't think this is going to blow up into any kind of financial crisis, but it was a reminder. And if you remember when the banks were having the problem back in March, I mean, the bank index was like that, straight down. So yesterday was just kind of a little reminder that, hey, we're still out here. We still got banking issues. And so all that kind of came together at a time when the market's just been going straight up. And we were talking about, need a catalyst, need a reversing candle, need something, or else you stay long this market. Well, I think we got that something yesterday. So let's take a look at the action and see what we have talk about from yesterday. So Dow Jones Industrial Average finished down on the day, 317 points. That was your winner, by the way, down 317 points. It was down 0.8%. S&P 500 down 80, 1.6%. The NASDAQ 100 down 339 points. That was almost 2 full percentage points. Mid caps down 1.85%. That was 51 points. And the small cap Russell 2000, the IWM, which tracks the Russell 2000, falling $4.83. That was 2.44% on the small caps. Again, a lot of those small banks had a lot to do with that, small to mid-sized banks. Transports down 1.65%. They lost 250 points. Back down right to that 50-day moving average. Still a little bit above the 15.2 level that I like to look at, but we'll look at this chart a little closer in just a minute. Moving on to the sectors, we saw strength where you normally would expect strength during a down day, a big sell-off. Most of the time, those aggressive groups lead to the downside, and it leaves us with defensive stocks at the top. Yesterday was no different. Healthcare lost 0.14%, barely anything. But it was a pretty big reversing candle. We had gapped up on healthcare, had a breakout, and then came back down, closed below the breakout level. So even on our best sector chart, there was maybe a little bit of bearishness, because if you see that failed breakout right there, check out the PPO, which has been coming down. So we've got slowing momentum, and then we got the reversing candle, and that was one of our best sectors yesterday. So it was not a good day. I'm not going to sugarcoat this at all. Leading to the downside is exactly what we would expect to lead on the kind of day we had. Communication services, which has been absolutely on fire, had a tremendous January, which historically, it's right in the historical playbook. Communication services historically has been our best group during the month of January, especially internet stocks. And here is we saw January coming to an end with their rally coming to an end. Communication services dropping almost 2.5%, all the way back down 75.88 from the recent high. We don't have a negative divergence here. So this is a group, maybe we watch off of the 20-day. Maybe it hits the 20-day today. And then again, I'm just going to remind you, Meta reports after the bell. I think it's one of the better looking charts going into earnings, which is why I'm kind of holding out hope that we're going to get a good report. Doesn't necessarily mean we'll get a good market reaction, though. Meta's been on fire for a long time. It could be that this period of consolidation or even short-term selling might kind of engulf even the companies that report good news. So it's going to be very interesting here over the next day or two. We have non-farm payrolls coming out tomorrow if you need some more fireworks. So there's a lot going on in the market. I think it's now set up where bad news might not be taken quite so well, because we've now already begun what could be a short-term downtrend. So we're going to see how all this plays out. Technology, also a weak day yesterday, down more than 2%, losing $4. It had climbed over 200 here in last couple weeks, and back down yesterday below 197.58. And the 20-day is 196.96. So we are literally within about 70 cents of the 20-day moving average. And you've got a negative divergence. And remember, 20-day moving averages are great when that PPO is strong. When you've got a negative divergence, I look for 50-day moving averages for support, not 20. So with the reversing action we saw yesterday on the increasing volume, I mean, if you look across here, the Dow volume picked up, S&P picked up, NASDAQ 100 picked up, mid caps were higher, small caps were high. I mean, just about across the board, we saw really big volume, and we saw a big sell-off. That combination, clearly we know where our target is to the upside. What we need to do is break back out above yesterday's highs. It's not going to be easy, though, with the kind of momentum that we saw to the downside yesterday. So anyhow, technology, watch the 20-day, but I have a feeling that probably this is going to be the period where we're going to see some of these support levels go. If it doesn't, we'll react to it and go from there. I'm just talking about probabilities. Nothing in the market is ever guaranteed, especially in the short term. But looking at the probabilities, looking at these charts, looking at the increased volume, the selling and so forth, you have to respect it. And I think in the short term, I would not be surprised if we see some additional selling. Looking at the industry groups, these are just three of the groups that kind of led things to the downside. And you'll notice banking isn't one of them. And I talked about banks, being pretty weak. It was mostly the smaller and mid-sized banks. The large banks didn't really get hit nearly as hard as their smaller counterparts. So that's why you're not seeing it here, because the bank index has a lot of those larger banks that were not hit as hard. But looking at the overall groups that did show a lot of weakness yesterday, one was internet. Of course, we talked about Alphabet, Google. That was a big, big part of the internet weakness, but drop of 5.5% in one day. That was a big drop. And then you've got clothing and accessories, which were down 4.33%. That was 15 points on the clothing and accessories index. And you can see that dropped it not only below the 20-day, but also the 50-day. And now we got a little bit of support here around 325 to 330 on the clothing and accessories index. I'd like to see that level hold, because this was an area of the market that went straight up. And if it doesn't hold this little bit of support right in here, I could see a quick trip back down close to 300, 310. And we're talking about another 10% from here to get down to those levels. So clothing and accessories could be one area discretionary that poses a potential problem here in the near term. All right. Telecom equipment, also very weak yesterday, and that was just out of the blue. This is a group that had been doing extremely well. PPO is very strong, and that didn't even hold at the 20-day moving average with a very strong PPO. So we had bullish momentum, and yet we easily went down and took out this level. Looking from a price perspective, I would expect that 1600 level to be a short-term support area. We've got just a little over 1% to get down there. We'll see whether or not that level holds. But across everything I've shown you here, you can see that there definitely has been some technical damage from the action yesterday, probably more so than any day I can recall, maybe in the last 2 or 3 months. Probably the worst day I've seen. And most of it was after the Fed meeting, by the way. So, action from that relates to the Fed can be extremely volatile because it's not just Powell at the FOMC meeting, but now we've got all the Fed presidents and everybody, on the committee going around having their little powwows with different groups and so forth. And so you're getting news from all these different Fed presidents. All it takes is one to say, well, I think, rates are probably going to get cut sooner than many think or something. I don't know. Anything can happen. We could make up anything. But my point is that there's a lot of talk and chatter around the Fed, a lot more meetings, a lot more media focus and so forth. And so those stories could be driving the action here in the near term, or maybe up until the next Fed meeting. I'll also point out 2 things relating to history that I think we need to keep in mind and really just kind of muddies the water even further. The last day of a trading month or calendar month and the first 2 days of the next calendar month, those 3 days are the strongest 3 consecutive days in the calendar month historically since 1950. Yesterday was the last trading day of January. This morning and tomorrow are the first 2 trading days of February. I mean, this is when the market normally, not all the time, it's not like it goes up 100% of the time. It's probably these 3 days, probably the end of the 3 days. If we looked at the close on the 2nd versus the close on the 30th or the 29th or whatever the last close is before the final day of the calendar month, if we looked at the change over those 3 days, I would guess that the S&P 500 is probably up between 65-70% of the time. So we're still talking about 1/3 of those months not going up. And I always try to, clarify that when I talk about history, because history provides us clues. It provides us tendencies. It does not provide us guarantees, which is why I always say that seasonality is a secondary indicator. Think of it like the PPO divergences. Do you see every divergence work? I mean, I don't know, what percentage would you put on it? I don't know, maybe 60, 70, 75% work. Eventually, they may not work the day that the negative divergence shows up, but at some point we get a reversing candle and then they normally play out. But I don't know what the percentage is, but that's just it's one signal. The PPO, or if you use the MACD, any kind of momentum oscillator, you get a negative divergence. That's just one signal. No, not a guarantee. Seasonality should be viewed in that same light. It's one signal. What does trading on the 1st of February this year have to do with trading on the 1st of February all prior years? I mean, we have all kinds of different conditions that we're dealing with. We just had a Fed meeting. Most February 1st are not dealing with a Fed meeting, just occurred the day before. So you got a lot of different things that happen. But what you can't ignore is the fact that money flows come in at the beginning of every month. 401ks, all that money. So that's why the tendency is for it to go up. But that doesn't mean the market can't go down. And I just point that out because normally 31st, the 1st, and the 2nd, everything else being equal, I'd be bullish just based on that seasonality stat that I'm well aware of every single month. I think you have to take that into context with these other signals, though. And these other signals are not supporting the market just taking back off again right now. So we'll see. But futures are up. Actually, the Dow looks like it's gone red. I'll give you those numbers here in just a minute. I kind of lost my train of thought. There was another seasonal. Oh, so first quarter versus the second quarter of every calendar month. I can tell you that for the month of February, since 1950, it's basically a flat month. It's not a good month. February is probably ranked like 9th or 10th out of the 12 calendar months if you're just looking at pure performance by the S&P 500. And again, my population is going back to 1950. Some might say February is good, looking at the last 3 years or 6 years or 8 years. You can kind of do whatever you want. I'm talking about 74 years worth of action. And it's ranked pretty low. I don't know, maybe it's 9th, 10th, 11th. I know September's up there. August is probably not very good. Maybe June. I don't remember all the months. But anyway, I know that February is not a good month. But within February, the first half of February tends to be the stronger half. And then once you get past February 15th and you get past most of earnings season, from 15th through the 31st of March, second half of the first quarter is much weaker historically than the first half of the first quarter. And that's true for all the first three quarters. Quarter one, quarter two, quarter three, all are like that. And I think a lot of it has to do with, market's going up pre-earnings, a rally pre-earnings, and then the earnings come out, market continues doing well, and then we have no more earnings to talk about. And then profit taking kind of kicks in. And in February, second half of February, you get options expiration. And then March, you have another options expiration. March isn't a great month either. And then we go into April, and then we kind of repeat the cycle. So on the one hand, we've got some historical data that looks pretty bullish. 31st, 1st, and 2nd. Normally money's coming in. Money flows normally drive the market higher. But then we've got the 15th coming up, and just simply the month of February, which is not a great month. So you got, a little battle going on in seasonality, the reversal. Anyway, just to sum it all up, I think now is the time to be a little more cautious. Until the market can actually break out again, I would be cautious. I think this could be the start of more consolidation, maybe even selling. One thing I talked about at Market Vision 2024 this year was I thought during the first quarter wouldn't be a great quarter. It would be choppy. I thought we might get up and maybe scratch against 5,000. I'm not sure if we just saw the high in the first quarter, but I think it's very possible. So with that, I would just maybe be a little bit more cautious until the market proves otherwise. And whatever that means to each individual. I mean, everybody's different. Some might say, oh, I'm just going to sit in cash. That's fine. Just be aware if it does break out again, we're in a secular bull market. So I would not be sitting in cash for long if we start talking about all-time highs again. Anyway, let's move on. We got some other stuff to cover, and it's already getting late. 10-year Treasury yield. So this was interesting because the 10-year Treasury yield kind of did what I expected it to do, but the stock market didn't do what I expected it to do. Because I would have thought that if the 10-year Treasury yield yesterday was to drop from, let's see, we were at 404. We were at 404 on Tuesday at the close. Then we dropped to 397, 3.97% at yesterday's close. So we dropped 7 basis points, which to me is telling me the bond market's not worried about inflation. The Fed might be saying, hey, we need to see a little bit more evidence going toward 2%. The bond market said, I've seen enough. I don't need to see any more movement. So what happens? Folks jump into bonds. They're not worried about inflation. All of a sudden, those returns look much better on an inflation-adjusted basis. So people are jumping into bonds, sending the yield lower. And normally, if the bond market's reacting like that, you would expect the stock market to say, hey, bond market not looking for inflation. If there's no inflation, that means rates are coming down. We still got a fairly strong economy. I would have expected to see the market jump on that, but it didn't. Maybe delayed, might be delayed a week, might be delayed a month and a half, might be delayed 2 months. I don't know. Let's take it one day at a time here. But yesterday was not a good day. Let's just leave it at that. I think that's pretty obvious too. But anyway, 10-year Treasury yield. Oh, and I didn't look at the economic reports, but I know, of course, we got a couple reports to take a look at this morning. First, initial jobless claims. We always like to look at initial jobless claims. They came in a little higher than expected, 224,000 versus 215,000. So that's a little bit of a sign that maybe, the economy is not quite as strong. And as a result, Yields coming down again today. We're down another 7.5 basis points. So yesterday we dropped 7. We're dropping another 7.5 today. 14 or 15 basis points in 2 days. What else did we have? I thought productivity and costs. That was the other one I want to look at. So productivity jumped. That's awesome because it helps in terms of wage inflation. If everybody's becoming more productive, then that ultimately is going to be a good thing for inflation. Non-farm productivity annual rate was expected to come in at 2.3. It came in at 3.2. Good news. Unit labor costs annual rate was expected to come in at 2.1. It came in at 0.5. That's a low reading and below expectation. I mean, last quarter, we saw that annual rate actually showing a revised number of minus 1.1%. But we were expecting that to jump to 2.1 and only jumped to 0.5. So again, it's showing us that the inflation at the wage level is still not what a lot of folks were expecting it would be. It's not as great. And I think that takes a lot of pressure off the Fed, at least as far as hiking rates. I think pretty much everyone agrees they're done with that. But it also could speed up the process of these rate cuts. We'll see. I was not looking for March, by the way, for a rate cut. I think June, May in that time frame. I'm not sure. I haven't looked at the dates, but May, June is kind of when I would expect that we would see maybe the first rate cut. Let's see. All right, we got a couple other reports coming out later in the day. PMI manufacturing, ISM manufacturing, which is just a component of the PMI manufacturing number. Construction spending. And then, of course, tomorrow's the biggie. We got the employment report, non-farm payrolls. And that could have a huge impact on both the bond market and the stock market. So we got, like I said, more fireworks coming before this week's out. But let's see when the dust settles with all of this week. Let's see where we finish the week. But my guess is we're not going to go back up and take out that high unless we get some reports out tonight, earnings reports out tonight that are just absolutely crazy. Meta is one that could be. We'll see how that goes. All right, S&P 500, big move down. I would have preferred had we, gone gapped up and then had this big engulfing candle. I think that would have shown more in terms of a reversing candle on the S&P. But we can't ignore the biggest volume day of the year and the fact we closed on the low. You can see the impact it has right here on the AD line. A pretty decent drop because the volume's the multiplier. And if you finish right on the low, which is exactly what we did yesterday, all of this volume gets subtracted. Whereas usually you're only going to have a fraction of the volume depending on where you close within the range. But yeah, I mean, just it seems like it's been a struggle to kind of tack on any more points of late. And then, again, the Fed gave the stock market a reason to sell off, or at least part of what the Fed said gave the market a reason to sell off, and it did. NASDAQ 100, bigger sell-off, but you can see these negative divergence. There's a higher price, there's a lower PPO. Go back to the S&P 500, higher prices, lower PPO, and now we're starting to see that PPO roll over. Now it's starting to look more like a negative divergence that's ready to begin, fixing itself, moving more and more toward the center line on the PPO and moving more toward the 50-period moving average, in this case, the 50-day moving average. That could take us down to 4,700. I mean, we're at 48, 45. That would only be like 3%. But after moving, to all-time highs above 4,800 and getting above 4,900, I can promise you 4,700 is not going to be received well. And the media is really going to start kicking in, talking about maybe that's the top. Now we're done. And then you're going to get the bears parading on CNBC. Oh, we're going back down to the October 2022 low, or maybe the October 2023 low at least. And they'll have some saying, oh, we're going back to the pandemic lows. I'm just telling you, get ready, because it's all going to start again. As soon as you get any selling, we could go up for 100 days in a row and you have one bad day and the bears are going to be back out again. Anyway, down here in South Carolina, maybe an analogy would be, when it's sunny and hot days and days and days in a row and then it rains. I don't know if you're familiar with fire ants, but on the golf course, you see these fire ant hills, and they're no joke, by the way. Fire ants are no joke. But as soon as it rains one time, they're all back out again. I mean, they're out in force. So that's kind of what it feels like with the stock market. You know, you go up, you go up, you go up, beautiful sunny days, and then all of a sudden the fire ants come out when you have a day like yesterday. We'll see what happens. NASDAQ 100, as I said, not good action there. IWM, really weak. I did not like losing that 20-day moving average. We still have the recent low down at 187. Don't want to go back down there again, but yesterday's action certainly says it's a possibility. And if any more news comes out about these small banks, I mean, if you look back in March when the IWM took the big hit, I don't expect to see the kind of news that we saw back in March, but all it takes is a couple of days. I mean, look at how fast we went down. Look what we did yesterday. It could be simply 1 or 2 more days. You get another bad report out of a small bank, and you could see this down. And I talk about small banks because banks are the largest holding within the IWM. So you got banks and you got biotechs. Those are the 2 key indices. And so banks, those small to mid-sized banks did not do well yesterday. And they drove the IWM down considerably. And you can see, again, that volume was strong, losing a major support level like the 20-day. I wouldn't be shocked if we see another test of that 187.5 level. And then from there, of course, we're going to want to watch because you break down below there and then you start looking at other levels. And it just at that point takes on a much, much more bearish look on the charts. So let's take it one day at a time. But I don't like I said, I don't like some of these breakdowns that we've seen. Transports was another one. I mean, we opened at 15.8 above the 20 and above the 50. And by the time we closed, we were below both of them. Down 1.65%, 260 points. I mean, that's a big down day on the transports. EarningsBeats, come on over. This is our website. This is my home, EarningsBeats.com. We'd love to have you come out. We got a 30-day free trial to our paid service, 30 days for free. You do need credit card for that one. And we've got an event tonight, by the way, where we are going to be talking about the effect, the January effect, and the fact that we have the whole month of January, how it performs. It gives us clues. Again, just another signal, not the Holy Grail. Everybody's always looking for the Holy Grail. I don't have the Holy Grail. Nobody has it. But what I do know is that January does provide us pretty significant clues about how the rest of the year is going to go based on how January goes. That's one of Wall Street adages. As goes January, so goes the year. Maybe you've heard it. Maybe you haven't. Now you've heard it. But we'll see. I think January was a decent month. I believe this year is going to be a good year. I'll just leave it at that. But we're going to have pullbacks along the way. We also have the election year cycle to deal with. And this first quarter choppiness kind of goes right along with the what we normally see during an election year. Got a lot of things that we have to think about, down the road. Got another what appears to be big rematch between Biden and Trump. I have to believe that that's going to cause a lot of turmoil and nervousness later in the year. So it's kind of important to understand how history tends to play out both in election years and outside, just all years. And so that's part of what we have to evaluate as we go forward. But one of our first steps is looking at January, because now it's February 1st. We got January in the books. I believe the S&P 500 was up like 1.5%, but I have to double check that. So we were up, which is good. If you have a bad January, that's generally not good for the market for the rest of the year, or at least the odds of having a rough rest of the year go up considerably. But it wasn't the best January either. So what does it mean? Well, we're going to talk about that later today. In fact, if you ever click on this About Us and go down to our event calendar, you can pull up our events and see what we have coming up. But today at 5 p.m. Eastern, the January effect revisited. So I talked about it going into January. Now we actually have the numbers, and we're going to talk about what this could mean for the balance of the year. It is members only, but your 30-day trial gets you in. So anyway, check that out. Come join us. We'd love to have you. You got 30 days to kick the tires and see if we're, kind of what you're looking for. Also, we have a free newsletter. This one's really simple. No credit card. You can unsubscribe at any time. It takes a name and an email address. That's it. I send out basically 2 paragraphs in a chart every Monday, Wednesday, and Friday. So 3 times a week. Just gives you a sense of how we trade, how we approach the market. It gives you maybe a little bit of insight into all of our guidance, our education, our research. So it's, like I said, it's free. Tens of thousands of folks have subscribed to our newsletter. There's no reason not to. But anyway, you can check that out. But let's take a look at the chart of the day. And I'm pulling up Google, because Google was something that we've talked about. It was not a good looking chart. You look at the chart, just the absolute price, and you say, well, it's been going up all year. It's at a 52-week high. What are you talking about? It's not a good chart. Well, it depends on, if you're in internet, if you got stocks in internet, chances are if you've got Google, you got one of the worst ones. And that's because if you look at Google relative to the internet group, look at where we were a year ago up here, and look at this nice little roller coaster ride all the way down to a 52-week low. It is trading as low relative to its peers as it has at any point in the last year. Should we be shocked that Wall Street wasn't impressed with their report? I mean, not only did we gap down, we saw some gap downs and some buying afterwards. We saw none of that with Google. We gapped down, opened at 143.40 or 143.62. The high was 144, and we came down and closed almost right on the low. Closed at 140.10. The low was 139.87. So basically, it was just an all-day selling event. And if you look at the 10-minute chart, you'll see that here we are. We had a couple bounces in here, but there we go to the downside. And I see the market's open. I'm definitely running a little late this morning. But we got a little upside at the open here on Google. I'd be shocked, though, if we see, well, maybe with Meta coming out after the bell, if they have a good report, maybe we get back through this level. But I do not see the relative strength building on Google for a while. And you really don't want to own it until it starts to show that relative strength. Anyway, so that's the chart of the day. I just wanted to show this, how relative strength can influence what you do in your terms of your trading. I would never hold a stock into earnings that is showing this kind of relative weakness, ever. I don't know what Wall Street knows or thinks they know that I don't know, but I don't want to stick around and find out what it is. So anyway, couple of charts from yesterday, just want to mention quickly. Boeing actually went against the grain, and the reason why the Dow performed better than the other indices mostly was because of Boeing. Boeing came out with their earnings. They topped expectations, top and bottom line. You can see it had a nice 5% gain. That literally, there's only 30 stocks in the Dow. So this is one that literally held up most of the entire index on its shoulders yesterday. Also, we had Microsoft reporting earnings. You can see the big move down there after it went up and set a new high. Now that false breakout, big reversal, heavy volume tells me there's a good chance that Microsoft topped. And that's why it kind of makes me think, well, if Microsoft topped, probably we're looking at the market. I mean, Microsoft's just one stock, but it's very influential in both the S&P and the Dow. So this was not a good looking chart on Microsoft. And Microsoft, if we look at it on a relative basis, it's really, look at it relative to software. It was not a great chart. I mean, everybody talks about Microsoft, $3 trillion market cap, blah, 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 but it was just going sideways here, right? So it's not really showing a lot of relative strength, even though on a chart, it looks like it's the leader and it's been helping the market, but there are plenty of other software stocks that are doing better than Microsoft. Stryker actually went against the grain yesterday, and we closed below the open, but we had a big gap up. So we did get a nice breakout out of a lot of consolidation. We may see a little bit more selling on SYK going back toward gap support, but ultimately I would expect the stock to go higher. We'll see what it's doing now today. And it's down a little bit lower. So maybe it's starting to make its way back down. When you get the big gap up, you got market makers on the other side providing liquidity. They're shorting. That's why most stocks start to either fill or at least start to make their way toward filling. Anyway, that's basically what I had. So let's just wrap this thing up here. It is 9:40 now, so really late. Dow up a little bit. S&P, I never did give you futures, but now you got the real thing. S&P up about 0.5%. NASDAQ up 0.75%, jumping out of the gate to the upside. Small caps also up 0.75%. So we got a little bit of strength there with the small cap group. Pull that one up. And then the VIX, after jumping yesterday up to 1435, which still was pretty low when you look at the history, didn't really jump up that much, but it's coming back down today with a little bit of strength. We'll see. Again, I think the bulls have a shot tonight with Meta. If Meta disappoints, I'll be shocked, number one. But that would not be a good look on the NASDAQ tomorrow or on the S&P 500 for that matter. So my eyes are going to be on Meta after the bell today because I think that's the one area of technology, communication services, that whole aggressive part of the market that I think, could give the market a lift, even if it's just temporarily. So watch Meta after the bell today. And of course, non-farm payrolls tomorrow. Anyhow, that's it for me. Everybody have a great rest of your day. Again, later today at 5 p.m. Eastern, we will be having our January Effect Revisited webinar where I'm going to tell you what I think the January performance means or likely means for us for the balance of the year. I'll probably give you some kind of a range that I believe where the S&P 500 is most likely to travel throughout 2024. So please, if you can, join me for that. 30-day free trial is all it takes. So go over to EarningsBeats.com right there. Start your no-cost trial. We'd love to have you. Have a great day, everybody. Happy trading.